retail FX market allows individual investors to bet on the direction of currencies, including the U.S. dollar, Japanese yen, and the British pound. Before you start trading, however, you'll need to understand how it all works. First, trading is done in pairs.
You can't do one without the other. What I mean is if you're trading in the yen-dollar pair, there's two trades that happen, right? You're simultaneously making a decision to say, on a relative basis, just those two currencies, one will strengthen and hence zero-sum, one will weaken. So you actually have two ideas there. So understanding the concept of it's not a physical piece of paper that you buy with a stock or a bond. You have to move on beyond that and say, actually, I'm making a decision looking at the relative value of two countries.
The currencies that are traded against the U.S. dollar are called the major pairs. Those pairs that do not include the U.S. dollar are called crosses.
It's sort of a lose-lose proposition for the euro.
Brian Dolan is chief currency strategist of Forex.com, a division of Gain Capital.
There's over 180 different currencies in the world, so about 6 major pairs account for about 80-85% of daily trading volume. Those being the euro against the U.S. dollar, the dollar against the yen, the pound against the dollar against the Swiss franc, and then the dollar against the Aussie and the Canadian dollar.
Dolan says there's one way to put the world's many currencies into perspective.
There are 3 major blocks: the dollar block, the euro block, and the yen block, roughly corresponding to 3 major economic regions of the world: North America, Europe, and Asia.
That's why there's no such thing as a real bear market in currencies, because one is always rising and the other is always falling.
Thanks for watching Bloomberg, The Educated Investor. I'm Carol Biaggi.